Dear students, today's assignment is module 26, which talks of business restructuring and specifically slum cell. Now, before I move into slum cell, let me discuss a small about the business restructuring. What a business restructuring is? A business restructuring means rearrangement of your affairs, right? Now, there are different ways through which a business can be restructured. It could be, say, conversion of a sole proprietorship business into a limited company, or a partnership firm into a limited company. Conversely, an unlisted firm converted into LLP, then amalgamation, demerger, slum cell. These are the ways through which a business can be reconstructed. Now, earlier we have discussed amalgamation and demerger. Now we shall discuss the slum cell. Now basically, what is the difference between these three, the amalgamation, absorption and the slum cell? Basically, amalgamation and the demerger, it can be done only in case of companies, but slum cell, it has not been specified to companies. Any other entities can go for a slum cell. In case of amalgamation, demerger and the slum cell, basic difference is what then the question is, then what is a slum cell? Now, section 2 subsection 42C of the Income Tax Act defines what is slum cell is. Basically, what is slum cell is, because you will appreciate when one entity takes over another entity, the transfer entity will get the assets and liabilities of the transferor entity, and for this they have given some consideration which we call purchase consideration. In that cases, the values are assigned to the assets. Suppose I have taken asset A at this value, asset B at this value, asset C at this value, then I am adding this, then I am getting the PC. But in case of slum cell, what happens? You are purchasing an entity, but you are not assigning any value to the assets and liabilities. Just you are given in one PC against a lump sum payment. Like say there is an agreement through which A Limited will take over B Limited, or an entity, any other entity, take over another entity, say for an amount of 3 crores. That's all. It's not assigning any value to the individual assets and liabilities. So that is a case of slum cell. Now, what happens in case of slum cell? The tax implication. So once again, in the same way I discussed in case of amalgamation, what I discussed in case of demerger, I will discuss the same from the point of view of the selling entity, the shareholders of the selling entity and the purchasing entity. Now, I am not selling this, studying these and amalgamating or demerged company, etc., because you may call it a transferor entity, because it might not be a company. So first, I will start the implication from the point of view of the transferor entity. What happens? First of all, what happens to the assets which are being transferred? How you compute the WDV? Now, WDV to be computed as follows: you take the opening balance or the opening WDV, to which you add the assets you have acquired during the year, from which you deduct the assets which you are disposed of during the year, and then you deduct the value of asset which has been transferred under slum cell. Right? Now, how we can get the value of asset transferred under the slum cell? Now, you can get it like that. You take the cost of the asset transferred. Once again, the cost of the asset transfer, therefrom you deduct the depreciation which is charged up to assessment year 88-89, then from depreciation up to assessment year 87-88, and then from assessment year 88-89, assume this is the single asset in the block, because block of asset concept starts from that assessment year. So now whenever there is a block of asset, you will appreciate you can't charge depreciation on an individual asset, because once an asset entered into the block, technically it loses its entity. Now everything about the block. But if some assets are being transferred under slum cell, I have to compute like that. Right? Now what happens? I'm just recapping the whole thing. Opening WDV at purchases of asset during the year, less sale proceed of the assets, less value of asset transferred under slump sale. So there may arise two situations. What are those? First of all, the figure may be positive. So if it is a positive, you can claim depreciation on that. But if it is a negative, just think of your section 32 provisions, depreciation. If it is a negative, we call it short-term capital gain, right? Short-term capital gain or loss, whatever may be the case. But here you can't charge this as a short-term capital gain or loss because the provisions are very interesting. If you remember, in case of amalgamation, in case of demerger, what happened when the transferor entity transferred the assets to the transferee entity, that is an exempted transfer. So there was no capital gain. But in case of slump sale, which is governed by section 50B, provision is somewhat different. It is taxable as a capital gain in the hands of the transferor entity, right? So when the block shows a negative, it should be taken as 0. You cannot claim any depreciation on that. Now come to the capital gain concept. Whenever the assets are being transferred under slump sale, it arises capital gain. So this is a big difference between the slump sale and the amalgamation and the demerger. Now how to compute the capital gain? Capital gain can be computed like that: sale proceeds, therefrom you deduct the expenses on transfer, and therefrom you deduct the way we did the capital gain, cost of acquisition. Now the question is, what is the cost of acquisition? It states that cost of acquisition is nothing but the net worth of the transferor entity. Now how you compute the net worth? That is also given. That net worth to be computed like that, it is the WDV of the depreciable asset. Mind it, not book value. It is the written down value of the depreciable assets plus book value of the other assets, but you should not consider any revaluation. Suppose take an example. Suppose a land is transferred. So you know land is a non-depreciable asset. Now say land value is 100, but 2 years back it was being upvalued by 20. Right? So now technically its value should be, whenever you consider for the purpose of COA, you shouldn't take 100, you should take 100 minus 20, 80. Right? So once again, it is the WDV of the depreciable asset plus book value of the other assets minus the liabilities taken over. So whatever the net figure, that is called the net worth, and that is equal to the cost of acquisition. Right? But the interesting thing is, and you know that it could be long term or short term, it depends on the holding period. But the interesting point is that even if it is a long term, there is no indexation benefit. Right? So this is an exception to that, because we know that always if there is a long term capital asset is being transferred, there is an indexation benefit. But there are certain cases when even if it is a long term capital asset transfer, there is no indexation benefit, and slump sale is one of that. Another is you call debentures or the bonds, right, or the enhanced compensation. So in those cases, you can't get any indexation benefit. Another point is brought forward loss or another depreciation that cannot be transferred in the hands of the transferee entity. It has to be continued by the transferor entity, right? So these are basically the, in a nutshell, the tax implication in the hands of the transferor entity. Now what happens to the shareholders of the transferor entity? There is no tax implication, because generally it is paid in the lump sum, one shot, so shareholders are not somewhere connected to that. So there is no tax implication, which we had in case of earlier, in case of amalgamation or in case of demerger. And thirdly, from the point of view of the transferee entity. Now transferee entity, I told you that transferee entity now cannot enjoy any benefit under those sections, say 35, 35 ABA, 35 ABB, 35D, 35DD, 35 DDA, 35E, 3619, 10AA, TIAB, they can't get it, right? So this is not tax neutral. Earlier too was tax neutral, but this is not tax neutral. So these are the benefits, these are the tax implications in the case of slump sale. Thank you.